So you probably clicked on this video because you live in New York City. You're probably renting an apartment right now. You're saved up some money, but you've got a lot of student loan debt, like most of us. You might owe anywhere from $50,000 to $150,000, and you're wondering, with that kind of debt, if you qualify for an apartment purchase somewhere near where you work, so you can stop renting and stop paying all of this money to somebody else. So the question is, can you buy in New York City? And the answer is a little bit more complicated than that. There's several parts that we should talk about. And I think the first one is that most of the apartments that you might be taking a look at in New York City are cooperative. Co-ops have a completely different structure for how they approve somebody into buying into one of their properties, and it's a lot more strict than the banks will ask for. So that breaks down into two very specific areas. One is your debt to income ratio, and one's your post-close liquidity, how much money you've got left over after you purchase. These two metrics make it prohibitively expensive to buy into many of the cooperatives, despite making a great living and having some money saved. A lot of people these days are renting one-bedroom apartments in the village. They're paying maybe $4,000 a month for them. They're considering purchasing because they've got the down payment, but they don't have the debt-to-income ratio despite making at least $160,000, which qualified them for the rental in the first place. There is an alternative. There is an option. There's a way to purchase something and build wealth rather than leaving New York City and driving in or trading in with a huge commute and another bill that you're going to have to pay for. People that might be renting for $4,000 for that one bedroom in Greenwich Village, they can buy a $650,000 condo on the Upper East Side, or even a $550,000 condo of similar size in Washington Heights or Astoria. These areas provide several opportunities for the average buyer. One is potential growth, as these areas have a lot of room to appreciate over the years. Another is you get a lot of apartment for your money, but most importantly, these apartments are condos. Condos are a lot easier to qualify for, as your main barrier is the down payment you'll have to come out of pocket with, and also the mortgage requirements in order to finance, and neither of those are nearly as strict as what a cooperative's looking for. So there are several differences between condos and co-ops. I'd say the most important one to you, if you're considering purchasing, is the barrier to entry and the qualifications that it takes to get into these properties. The main difference being that if you want to buy a condo, all you really need to qualify for is the mortgage. Banks have a much less strict debt-to-income requirement in order to qualify for those loans. They'll take somebody who has a debt-to-income ratio of 45%, meaning that 45% of their gross income can be accounted for in their net expense. What does that mean? Well, if you're making $120,000 a year or $10,000 a month, the bank says you can spend $4,500 plus or minus on all of your expenses that show up on your credit report, from your mortgage and your taxes to any other debts that you carry at the time. A cooperative says that that same person making $10,000 a month can only afford $2,500 to $3,000 a month in total expenses. This is a prohibitive ratio for a lot of people who are considering purchasing, because they have to finance too much of the property and the mortgage is higher, especially with interest rates where they are today, or they have student loans or other debts that, when coupled with the mortgage, ends up making it way too high for a cooperative to consider. So main difference between condo and co-op: you can buy a condo a lot easier, and when you go to sell it, you'll have more buyers who qualify for your property. So let's say you're making $120,000 a year. Let's say you've got $100,000 saved. Let's say that you also have approximately $100,000 in student loan debt, and you're wondering if you'd even qualify to purchase something. And if you could, where would you be looking? Well, as I mentioned, $120,000 a year is $10,000 a month in gross income. A bank is going to say that you can spend up to perhaps $4,500 a month in all of your net expenses that show up on a credit report. So your student loan debt, where you might be paying as much as say $1,500 a month, that would be part of that 4,500, and what's left is $3,000. Now, $3,000 a month can buy you property in New York City. Where would I focus with $100,000 in savings that I could spend towards that purchase? There are areas in the Heights, Washington and Hamilton Heights, where you can buy one-bedroom condos for $450,000 that the financing plus common charges and taxes would keep you under that golden ratio that we just discussed. There are areas in Queens, like Forest Hills or even Astoria, if you get lucky, for a similar sized one bedroom. There's also areas in Brooklyn in emerging markets like Crown Heights, even further out, Bedford-Stuyvesant, some of those new developments that you can get into for $350,000 to $425,000. And some of these have brand new appliances and brand new builds. All of them are appreciating at higher than the normal rate, as all of them are outside of central Manhattan. All of them would provide for you the same tax deductions and opportunity, and all of them would give you the opportunity to build equity just through paying down the principal of your mortgage a little bit at a time. So let's break that down. If you're buying, say, a $500,000 apartment in one of the areas that we just talked about, and you're putting 20% down, you're financing $400,000 at 6.5% interest. With common charges and taxes commensurate with what you would be looking at in those neighborhoods, you're probably spending around $4,000 a month with a potential plus or a minus. Now, that's before the tax benefit that you'll realize once a year that could end up bringing that annual cost on an average to perhaps $3,500 to $3,200 monthly. You might be paying $4,000 a month in rent right now to rent a smaller apartment in several areas of New York City. Your monthly expenses don't even have to go up. Obviously, we're talking about a barrier, and that barrier is having that money saved. You would need that $100,000 plus a little bit in closing costs in order to qualify for the mortgage, purchase that property, and get into it. However, there's a lot of people that I've met in New York City that have savings but don't think and don't know that they qualify to purchase anything that they'd be interested in. A lot of them are shocked when they go see some of the apartments that they can actually afford in some of these emerging markets. And don't forget, there are still plenty of opportunities available even closer to central Manhattan. Upper East and Upper West sides, closer to the rivers, there are still apartments there that go for these price points as well. They might not be brand new, but there's plenty of opportunity there to update the apartment and make a lot of money over time. So now you may be thinking that if you hold off and interest rates come down, it might benefit you and you'll qualify easier and you can buy more apartment for your money. The problem is that there are a lot of sellers waiting in the wings, ready to put their apartment on the market the second that the market starts to show a little sign of life. And then, as you can tell from some of our last podcasts, it already has. Now, when sales continue to grow, prices will continue to go up. And even without the rebound from the last 18 months, we're talking about an appreciating asset. You may be able to save a few interest points if you're incredibly lucky over the next few years, but by the time you go to purchase that same property, it might be 5 to 10 or 15% higher. There is an alternative, and there's a lot of real estate agents across the country who have been using this phrase since before I've gotten in the business, and it's buy the home, date the rate. The ability to refinance exposes you to only the cost of refinancing. Refinancing on an apartment like the ones that we've been talking about might cost you anywhere from $4,000 to $7,000. You'll pay more interest over the first few years, especially in those amortization tables of a 30-year fixed loan, but you're also going to get a higher interest rate deduction, which is also going to save you quite a bit of money. And it's not going to be permanent, because if rates do come down, you'll have benefited from buying the property cheaper. You'll have several years of built up equity compared to just paying rent and building up equity for your landlord. And you'll still get the opportunity to refinance at the lower rate in the future if that were to become commercially available. You get the best of both worlds. So other people might ask, well, what happens if interest rates never come down? Should I just move out of New York City? Should I rent? What I can tell you is this: one of the greatest benefits to New York City real estate is that there's never been a 10-year swath of time where price per square foot property values have gone down. Now, that's really important, because that really speaks to the level of risk there is in buying something in New York City compared to almost anywhere else in the world. Buying in New York City is an extraordinarily stable investment. Buying it in the long term, you're going to make money as it's an appreciating asset, but the stability is almost second to none. But a lot of buyers this year have already kind of understood that interest rates, at least in the short term, at least this year, perhaps even next year, aren't going to be dropping as fast as people had hoped. 6 to 7% seems to be the new normal. And even if they go down in the future, more and more of them are over the sticker shock of the rates that are available today versus the rates that were available several years ago. And they're realizing property purchases that may be a few percentage points lower than they were a few years ago. But there's already more of those buyers entering the market. And the sooner that you can realize a property purchase, the sooner that you can get in on that rebound, plus the appreciation that you're going to expect by purchasing something in the first place. That's it, right? We're good? We're good.
I think we're good. Hold on. No, stay there. Don't move.
Okay.